Welcome to Spreadsheet Geek. In this video, we'll take a look at the incredible series of returns Warren Buffett delivered as the manager of Berkshire Hathaway. Using an Excel Monte Carlo simulation add-in, we'll simulate a population of active fund managers competing against one another. In doing this, we'll seek to answer the question of whether investing skill truly exists. Is Warren Buffett truly talented, or is he merely an expected outlier in a normal distribution of unskilled fund managers? This video was made using Microsoft Excel 2019. If you open up a web browser and you go to this web address, you can go to the Berkshire Hathaway website and pull up their 2020 annual report. Today is actually the last day of 2021 as I'm recording this, so the 2021 annual report is not available, but I can estimate what the returns of Berkshire Hathaway and the S&P 500 were for 2021. If you look inside just past the table of contents, Berkshire always puts in a comparison of the fund versus the S&P 500 with dividends included. Now, I don't know exactly whether they're reinvesting dividends immediately or just holding the cash and computing that as part of the return. It doesn't really matter, but this is a good comparison. For example, in 1965, Berkshire was up 49.5%, while the S&P 500 index was only up 10%. A very strong year of outperformance for Berkshire. What I've done is taken all of these values, copied them, and put them into Excel. Here's my worksheet. I simply duplicated those two columns of numbers, and I added one row down at the bottom for 2021. This is my estimate. I used Berkshire Hathaway B shares since they're a little more liquid. And as of right now, just a few hours before the market is going to close on the last trading day of the year, I've got Berkshire Hathaway up 29.4%, and the S&P 500, assuming immediate reinvestment of all dividends, is up 29.0%. So it looks like Berkshire Hathaway is going to eke out a slight advantage for 2021, and it didn't look like that until right in the last few weeks of the year. What I've done at the top here is add a fourth column for the delta between Berkshire Hathaway and the S&P 500. So I'm just going to simply take one value less the S&P 500 value and autofill those all the way down. You can see that there's quite a bit of variance here. Some years Berkshire Hathaway did extremely well versus the S&P 500, and other years like 1975, not so great. What I'd like to do with the numbers in this far right column is create a clustered column chart so I can see this visually, what we're dealing with in terms of outperformance. I'm going to insert a clustered column chart like this, and we'll throw a title on here. And I don't particularly want to look at these numbers. We'll change that axis under select data. We'll edit the horizontal axis to include the axis label range that includes the years here in the far left column, so that we have years on our horizontal axis. One other thing I'd like to do is reposition these calendar years down at the bottom so they're not overlapping my bars. I'm going to go to the Format Axis option, which is just off the screen there. Under Labels, you can put these next to the axis or in other positions. I'm going to choose Low and reposition those down at the bottom. So that's my chart. As you can see, there was a heyday of Berkshire Hathaway from roughly the beginning, 1965, to around the year 2000. And then since 2000, the performance, outperformance or underperformance has been kind of mixed. I would point out that there can be negatives that look like positives on here, and 1973 is a good example. In 1973, Berkshire Hathaway lost 2.5%, while the S&P 500 lost 14.8% for an outperformance of 12.3%. But that appears on the 1973 column as a positive, even though it was a loser. It outperformed the S&P 500. So that's how this chart works. What I'm going to attempt to do in this video is to determine whether a run of positive outperformance like Warren Buffett had in his career is the result of skill or luck. And the way we're going to do that is to run a simulation. And our simulation will assume that there is no such thing as investing skill. Imagine you're flipping a coin 1,000 times. There may be a run of 10 or 15 heads in a row somewhere in your 1,000 flips. That's what we're trying to do here. We're going to simulate a group of active portfolio managers and let the Excel simulation add-in software determine random assignments of portfolio returns for each and every year. And we're going to see if we can generate any Warren Buffett-like returns from any of our simulated fund managers. If we can generate a Warren Buffett in our pool of simulated investment managers, that would support the idea that investing skill really doesn't exist because it's a random phenomenon. On the other hand, if our best possible investment fund manager generated in the simulation is not as good as Warren Buffett, that would support the idea that investing skill really does exist. Our model is going to assume a perfectly normal distribution of investment manager performance. Half of our investment managers will be to the right of the mean and half will be to the left of the mean. And for any given year, the mean return will be the return of the S&P 500 index. Let's take 1978 for example. In 1978, the S&P 500 returned 6.4%. We'll make 6.4% the center of our normal distribution. In a normal distribution, 99.9% of the observations fall within 4 standard deviations to the left and 4 standard deviations to the right of the mean. We'll calculate the standard deviation and set up our simulation to choose fund manager performances randomly in this fashion. If through our random simulation we end up with a fund manager who through random simulation consistently ends up performing at the far right end of the spectrum, we may be able to generate a Warren Buffett. Before we get started, I'm going to turn on a couple of add-ins. So those are found under File, Options, Add-ins, Excel add-ins. And I'm going to turn on my simulation add-in as well as my analysis tool pack. We're going to use that very briefly. So as soon as those get turned on, you'll see on the data menu, you've got data analysis and Excel sim turned on. This is not something that comes with Excel. You have to go get this. And if you contact me, I'll tell you how you might be able to get it. It's for educational purposes only. So we're going to set the bar here. And what I did was go down to the bottom here. We're going to enter 3 values here, and one of them is simply Warren Buffett's average annual total return. That's a simple average of these years under the Berkshire Hathaway column, and we'll finish that off. So His average annual return is 24.4%. Now for the S&P 500, I need a standard deviation and an average total return. So I'm actually going to use my data analysis tool pack to do this. We're going to look for descriptive statistics. The input range is right here under S&P 500. Those are the average annual total returns. The output range, let's just make that right here. It's a convenient spot. If I could click that correctly. And we want summary statistics, which includes most of your major statistical readouts. So you get this little block of information here. We're interested in the average, which would be the mean. That looks like 11.9. I'm going to round that off. And the standard deviation is right here. That'll be 16.8. So let's put that in here. So now we've kind of set the bar here. Let me get rid of this stuff. Warren Buffett has set the bar at 24.4%. The average annual return of the S&P 500, that manager who performs at the market every year, is about half that, and the standard deviation is 16.8. So we'll need those inputs to set up our simulation. There's a couple of additional things we need to talk about before we run the simulation. One of them is fees. Back in 1965, there were no exchange-traded funds, and there were, in fact, very few mutual funds, but there were some mutual funds, and this is who we're going to look at. The fees for mutual funds nowadays tend to run around 1%. I'm sure they were higher back then, but I'm going to be somewhat arbitrary and assess a fee of 1%. So this after fee percentage will equal the S&P 500 minus the fee. Let's make that an absolute and autofill it all the way down. What I'm saying here is that in 1965, if you had a fund manager that performed as well as the market, he would have only returned 9%, not 10%. Berkshire Hathaway's Warren Buffett performance in this column over here reflects fees, so our managers should reflect fees as well. That's only fair. The other issue we need to settle is the number of portfolio managers. On Investopedia.com, it gives a brief history of the mutual fund industry, and there's a key paragraph in here that the mutual fund industry continued to expand through the 50s, and there were a number of open-ended funds that totaled over 100, and by the end of the decade, there were 50 additional funds added. So I'm going to go with 150. I'm probably being kind to Warren Buffett by selecting only 150. I would probably have a better chance of generating an outlier if I chose a larger number, but we'll just leave it at 150. So now I have all the information I need to run my simulation, and I just have a blank column over here that I'm going to use to do this. So I go to the data menu and I open up my simulation software, and I need to enter the changing cells. So let's use these, 1965 through 2021. The watch cells are the cells I want printed out on the report, so that'll also be these cells. And the watch names, I want to name those cells for the years. The iterations will be 150, one for each fund manager. And the sheet name, you just have to enter a name in here. And we'll move on to our first trial. This will be 1965. I want a normal distribution. I want my mean to be 10.9. And I want my standard deviation to be 16.8. So for that year, 1965, we'll have a normal distribution. The center of our distribution will be 10.9, and that's actually incorrect. We want the center of our distribution to be 9.0. And the standard deviation will be 16.8. So we'll have some fund managers doing 9.0. Those are the ones who match the market. Some will do better to the right and some will do worse to the left, and the standard deviation is there. So let's go to our next year. This year, we're going to plug in a negative 12.7 here and keep the standard deviation the same. The next year, 1967, will be at positive 29.9. That's the manager who performed at the market, and so on and so forth. I'm going to go ahead and stop the video and fill in the rest of these numbers. Okay, I'm back, and I've painstakingly entered all of those values down to 2020. In 2020, we have a mean of 17.4%, and in 2021, we're going to go with 28.4 as our mean portfolio manager return. Now, as soon as I hit OK, the simulation's going to run its 150 trials and write its 150 trials. We get this sheet here. I'm going to go down to the bottom of this and clean it up a little bit. There's a lot of statistical information down here that I'm not interested in. We can calculate that any way we want, anytime we want. And I'm also going to fix that format. And just to make this a little easier to look at, I'm going to make all of these 1 decimal place. So now we can kind of sanity check our results here. We've got our trials. Remember, each of these trials is a fund manager. So this fund manager returned 0.4% in 1965 after fees, and he lost 32.9% in 1966. The next one has a different performance. This is the random selection of the Excel sim Monte Carlo simulation. We have all of the years present. So as kind of a sanity check, I want to look at my average annual return. So that should be something close to 10.9%. So if we go through here and average all of these years of all of these fund managers right down to the bottom, I'm getting an average of 11.6. That's a little higher than my, what was it, 10.9%, but I'll take it. That's the random effect of the simulation. Now, the really important thing I want to do is find if I have any Warren Buffetts in here who are consistently, through random selection, performing better than the market. So I'm going to insert a column here and simply take the, I'll call this the manager average. And we'll just take a simple average of C4 through the end of this row. That manager did a little better than average, and he got a 12.6 average annual total return. Let's paste the rest of those down. And for lack of a better place, I'm going to set my best fund manager total return, and that's an average. That'll be the max of whatever's in this column. My max is 16.7. My best manager that I could generate through Excel simulation, assuming there's no such thing as investing skill, is a random manager who performed at an average annual return of 16.7%. So remember where we set the bar with Warren Buffett? 24.4. That is significantly higher than 16.7%. Now, in all fairness, I did run this same simulation a number of times, and I did generate on one of them an 18.2, but that still falls short of Warren Buffett's average annual return by actually over 6%, 6.2%. And if you're outperforming by that margin on an average annual return basis, you're going to do much better than the market. So I think there's something going on here with Warren Buffett that is above and beyond random outlier status. The thing that's kind of an interesting discussion is, why did Warren Buffett and Berkshire Hathaway do so much better in this roughly 2000 era compared to the more recent 20 years? If you were in another career field, such as a surgeon, an electrician, a pilot, or a machinist, you would probably be the best surgeon, electrician, pilot, or machinist on the last day before you retired. Your years of experience would allow you to do that job better. Why is it different for portfolio managers? I could understand how a professional athlete might lose strength and dexterity, and possibly people in career fields like music may lose some physical ability over time. What's going on with Warren Buffett? As an additional exercise, I ran the same simulation for only the last 20 years, ended at the end of 2021. For those years, Warren Buffett and Berkshire Hathaway, these 20 years, averaged 10.6% annual return, while the S&P 500 returned slightly better at 11.1, a 0.5% advantage. The results of my 20-year simulation are in this worksheet. Berkshire Hathaway, again, 10.6%. The best manager I could come up with through random simulation did a 23.2% annual return over this same period, and the S&P again was 11.1%. During this 20-year period, Berkshire Hathaway and Warren Buffett do not look anything but slightly less than average. I hope you found this video interesting and informative. Let me know in the comments section why you think Warren Buffett's performance over the last 20 years does not measure up to his performance in the earlier years. Please remember to hit my subscribe button if you'd like to see more videos like this appearing in your feed. Thank you for visiting Spreadsheet Geek.